As of 10:55 a.m. Eastern Time on November 12, 2025, Moderna stock, ticker mRNA, is trading live at $26.05 per share. That's a drop of about 1.36%, or 36 cents, in early to mid-morning trading on the Nasdaq. And on the surface, that price, $26.05, seems to confirm the dominant narrative. The story most people tell themselves, perhaps as they scroll through their Fidelity or Robinhood app, is that Moderna was a one-hit wonder. It was the pandemic darling, the stock that went from obscurity to a household name, hitting highs over $450 and has now collapsed back to earth, a ghost of its former self. That is the expectation. People see it as a broken IPO, a stock that had its moment and is now just noise, completely unlike the steady performance of Apple stock or the volatile but product-driven narrative of Tesla stock. But here is the reality that the surface-level chart watchers are missing, and it's something that caught the market completely off guard just a few days ago. The last earnings report on November 6th was, by one crucial metric, a spectacular beat. Wall Street was braced for a loss of $2.15 per share for the third quarter of 2025. Instead, Moderna delivered a loss of only 51 cents. That isn't just a small miss, it's a 76% positive surprise. The company is losing far less and managing its new reality far better than the street believed possible. This is the tension at the heart of Moderna today. The expectation is a company in freefall. The reality is a company that is aggressively and perhaps successfully managing its descent, while trying to build a new launchpad. The stock jumped 10% in the pre-market on that earnings news, showing that there is still a deep well of investor interest, even if the consensus remains skeptical. Let's look at the movement we're seeing today. That 1.3% drop is really just market noise, a continuation of the tug-of-war between the bulls who saw the earnings beat as a sign of life and the bears who are pointing to the rest of the portfolio. The trading volume today is average, suggesting no single large institution is dumping shares, but rather a general malaise. This isn't the high-volume panic selling of 2023. This is the grind of a stock trying to find its floor. For a long time, the common belief was that Moderna was just Spikevax. The company's fate was tied 100% to COVID-19 vaccination rates. And as those rates have normalized into a seasonal commercial market, and a competitive one at that, the revenue has, predictably, fallen off a cliff. Q3 revenue was $1.02 billion, which sounds great, but it's down 45% from the same period last year. That's the reality that hurts. But the challenge to that common belief is what was buried in the earnings call. CEO Stéphane Bancel and CFO Jamie Mock didn't just talk about revenue, they hammered one point home: financial discipline. Moderna is now on track to beat its 2025 cost-cutting plan by over $1 billion. Research and development expenses were down 30% year over year. Selling, general, and administrative costs were down 5%. This isn't a company just spending its cash hoard with reckless abandon. This is a company in transition, using its remaining cash, and it's a lot. They expect to end the year with $6.5 to $7 billion in cash and investments as a fortress. They are trying to bridge the gap from the COVID windfall to the next product. The expectation was they would burn through their cash. The reality is they are hoarding it, managing it, and trying to make it last until they can achieve their stated goal: break even by 2028. This is where the story gets complicated, and where anyone doing their own self-investing needs to pay close attention. An online investment in Moderna right now is not a bet on COVID. It's a bet on their entire mRNA platform. And that platform just took one of the biggest hits in its history. On October 22nd, the company announced that its closely watched Phase 3 study for its CMV vaccine, mRNA 1647, failed to meet its primary efficacy endpoint. This is devastating news. This was supposed to be one of the next big blockbusters, a first-in-class vaccine that many analysts had already penciled into their future revenue models. Its failure sends a shockwave through the valuation, as it calls into question how easy it will be to translate the COVID success into other areas. Science is hard, and mRNA is not a magic wand. That news is a huge part of why the stock is trading at $26 and not $66. So, the company is in a race against time. Can it get another product approved and commercialized before its COVID revenue completely evaporates and the market loses all faith? Let's look at the portfolio. Their new RSV vaccine, mRESVIA, is approved and rolling out. The problem? It's a tiny contributor. It only brought in $2 million in the third quarter. It's entering a brutal market against entrenched giants like GHK and Pfizer, who have their own successful RSV shots. Then there is the new COVID vaccine for the 2025-2026 season, mNEXSpike, which is approved and available. But again, this is a shrinking, competitive market. The real hope, the one that bulls are clinging to, lies in the other parts of the pipeline, the individualized cancer vaccine, in partnership with Merck, and their combination flu-COVID shot. These are the assets that could justify a valuation many multiples higher than where it is today. But they are also science experiments. And as the CMV failure shows, these experiments can and do fail. This is what makes analyzing a stock like Moderna so different from, say, Nvidia stock or Apple stock. With those companies, you can analyze iPhone sales or AI chip demand. With Moderna, you are analyzing clinical trial data. It's a binary event-driven stock, which is why you see so many retail traders on platforms like SoFi Invest and Robinhood getting wiped out. They trade the rumor, buy the hype, and then get crushed by the reality of a Phase 3 failure. This is why many investors prefer to delegate this kind of risk management to something like Schwab Intelligent Portfolios, which would likely only hold a name like mRNA as a very small part of a diversified healthcare ETF. The analyst community is completely split, reflecting this deep uncertainty. On one hand, you have Bank of America, which recently lowered its price target to $21 and maintains an underperform rating. They see the dwindling COVID sales and the CMV failure and believe the stock has further to fall. On the other hand, Bernstein just reiterated its market perform rating with a $25 target, right where we're trading, praising the critical cost-cutting measures but acknowledging the challenging path back to profitability. The consensus rating is a firm hold, which is Wall Street's way of saying, we have no idea. The median price targets from the 30 or so analysts that cover it are all over the place, ranging from that $21 low to some stubborn bulls still holding targets well over $70. This massive dispersion in price targets tells you everything you need to know. Nobody agrees on what the future holds. Let's take a step back for anyone who is just now starting their online investing and looking at this name. What does Moderna actually do? Its business model is, in theory, beautiful. It uses messenger RNA, which are essentially instruction sets, to teach your own body's cells how to make a protein that can fight a disease. For COVID, it taught your cells to make the spike protein, which your immune system then learned to attack. The theory is that this platform can be used for anything: flu, RSV, cancer, rare genetic diseases. You just have to write the correct mRNA code. This was the promise that took the stock to the moon. The company itself was founded in 2010 and spent a decade in research mode before the pandemic provided the ultimate proof of concept. The question now is whether that proof of concept was a one-off, or if it can be replicated. So what is the future outlook? What are the scenarios? The bear case is simple. COVID sales continue to fall, the RSV vaccine fails to gain any meaningful market share, the cancer and flu programs get delayed or fail, and the company slowly burns through its $6.6 billion cash pile over the next 5 years, fading into biotech obscurity. In this scenario, the BOA target of $21 looks generous. This is the expectation that many in the market are currently pricing in. The bull case, the reality that the optimists are betting on, is one of a successful, if painful, transition. In this scenario, the cost-cutting works. The company stabilizes its cash burn, using its $6.6 billion as a war chest to fund its R&D. The combined flu-COVID-RSV shot makes it through trials and carves out a significant piece of the $10 billion-plus seasonal respiratory vaccine market. The individualized cancer therapy, which uses mRNA to teach a patient's immune system to fight their specific tumor, shows incredible efficacy in its trials with Merck. In this world, Moderna doesn't go back to $450, but it becomes a stable, profitable, multi-product biotech company. It becomes a permanent fixture in Fidelity mutual funds and healthcare ETFs. The stock would, in this case, be worth multiples of its current $26 price. This is